Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, October 29th. The week started on a cautiously positive note across both sides of the Atlantic Ocean. Crude oil dived and the US dollar consolidates gains near the highest level since summer after weak US bond auctions of yesterday. Now today, investors around the world will be focusing on US JOLTS data and Alphabet and AMD earnings, both due after the closing bell. So equity markets across Europe and the US began the new week of trading on a positive footage, except for oil stocks. Of course, oil stocks didn't do well as the price of crude oil died 5% on the back of a more targeted than anticipated Israel attack in Iranian military facilities. It's probably not the end of the hostilities in the region, unfortunately, but it gives a certain relief to everyone that no one of these parties are willing to get the things worse than they already are. So the barrel of US crude is trading below the $68 per barrel level this morning at the time I'm talking here. I believe that a good part of the geopolitically backed long positions in oil around the $70 per barrel level were cleared at yesterday's sell-off, but trend and momentum indicators remain comfortably bearish. The RSI indicator suggests that oil is not yet in the oversold market territory, and all that means that there is room for further sell-off in the short run, with shorts targeting the $65 per barrel September support. And we actually see that the oil bears have the upper hand again this morning. Now we see once the actual sell-off loses steam, we will certainly see some minor upside correction in oil prices and probably a period of consolidation. Yet the medium-term price dynamics in oil remain tilted to the downside as, one, the Chinese growth struggle is not over just yet. Then bad news keep coming in from Germany, where the country's iconic car maker Volkswagen announced yesterday that they will be closing at least 3 factories, and they will also be lowering the salaries of tens of thousands of people working there by 10%. Then demand growth in other parts of the world remains on edge as well, because remember, OPEC has been cutting its demand forecast for the global economy back to back lately, and that's a sign of weakening. And then the central bank's easing motives should help support oil prices, but the reflation trade hasn't been benefiting to oil since the start of this year. Then OPEC themselves, OPEC countries are now willing to relax their production restriction plans, and the non-OPEC countries produce a ample amount of oil, led by the US, to a world that's actually trying to transition from fossil fuel to the alternative sources of energy. Now, all that obviously doesn't mean that oil prices will be collapsing or will be immediately minced, but the downside pressures will likely be felt until global growth and global demand prospects improve. And indeed, oil giants like ExxonMobil, Chevron, BP, Shell, and Total Energies are all expected to announce a combined 12% decline from the second quarter when they will be releasing their third quarter earnings throughout this week. So we could continue to see some weakness there. But besides oil, the S&P 500 stocks eked out a meager 0.27% gain yesterday, while US bonds fell amid weak demand for 2- and 5-year bonds at yesterday's auction. And the US 2-year yield, which best captures the Federal Reserve's policy plans, pushed higher above the 4% level, while the US 10-year yield, which is mostly a reflection of long-term growth, inflation, and debt dynamics, advanced to 4.30%. Then the US dollar consolidated at the highest levels since summer as the US presidential election jitters kept investors flocking into the safety of the US dollar and gold as well, which now hovers near its all-time high levels again this morning, and that despite the rising US yields. And the euro dollar regained the 108 handle yesterday, but without much conviction from the euro bulls, as the Volkswagen troubles in Germany remind investors about the difficulties that the European economies are having at the moment. So if Volkswagen actually decided to close its German factories, a thing that they've never done before, it is because the energy and human costs make operating in Germany quite inefficient for the company. And Volkswagen is certainly not the only company in Germany dealing with these issues. Hence the morose European growth outlook of the moment supports the dovish European Central Bank expectations. And that means that the price rallies that we might see in the euro are interesting opportunities to strengthen the bearish positions for those who expect the euro to weaken further. Now, across the channel, cable is offered near its 100-day moving average. Tomorrow's budget announcement in the UK will likely keep the sterling bulls from joining in before more clarity on that front, while the Japanese yen is slightly better a bit this morning, and the dollar yen is back below the 153 level, but the political jitters there probably call for an extended Bank of Japan support to the economy, and hence could delay the Bank of Japan's rate normalization plans. Or this is at least what investors around the world think is cooking in the Bank of Japan's kitchen right now. We will soon find out because they will be deciding on Thursday. But before that, investors' attention will shift to the US jobs data starting from today, with the JOLTS data due today. Then ADP data is due tomorrow. Weekly jobless claims in the US is due on Thursday, and the official NFP wages and the unemployment rate, again from the US, are due on Friday. Now, the Fed, those have certainly scaled back their too dovish rate cut expectations over the past few weeks due to the stronger than expected economic data. But there is no doubt that the Fed will be announcing another 25 base point cut when it meets next week. The probability given to that scenario is close to 97%. Unless we see another month of blowout jobs report from the US, which will be quite hard, to be honest with you, due to the strike at Boeing and hurricanes. Well, the Fed should go ahead with another interest rate cut next week. And a softer than expected set of jobs data this week will have the potential to convince those people who were actually betting that the Federal Reserve should maybe, but just maybe, take a pause in the December meeting to the rate cuts, and maybe feel the 50 basis point cut expectations for next week, and all that could eventually weigh on the US dollar. But the US dollar weakness will likely remain limited on the data into next week's US presidential election. On the earnings front, Alphabet, Google's Alphabet, is the first Magnificent Seven company to go to the earnings confessional this week. Now, together, the US big technology companies are expected to announce around 18% growth in their profits in the third quarter, and, well, hopefully for Nvidia, massive increase to their AI spending. So we're talking something like $56 billion US dollars spent on infrastructure like data centers, for example, and that's up by more than 50% compared to the same period last year. Now, Nvidia will not be reporting its own quarterly results for another month, but AMD results are also due today, and people will be watching that very closely. Now, Roundhill's Magnificent 7 ETF is back to flirting with its all-time high levels after the summer's AI fatigue, but the companies, the big tech companies, must deliver meaningfully better than expected results, and also brighter than expected forecasts for the future to justify a further extension of the AI rally to all-time high levels at a time investors are getting quite increasingly worried that the amount spent on AI may be exaggerated. So, any misstep could actually cost the US indices their latest rally, or at least a part of it, as the rest of the S&P 500 stocks, for example, are expected to announce just flat profit growth last quarter. And according to the latest data, 75% of the S&P 500 companies that already reported their earnings Well, they reported better than expected results. It may seem strange to you if you are new to this, but that 75% beat on profits is the slowest number since the fourth quarter of 2022 and could eventually hammer investor sentiment as the profit expectations themselves had weakened big time since last summer. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.